Hello, welcome to another exciting chapter of Introduction to Business Finance. In this chapter, we're going to be returning to our thinking about risk, and we're going to introduce a little bit of probability and statistics to be able to model risk in some better ways, some more robust ways. So with that said, let's jump right in. So far, we have considered risk, right? We talked about this in chapter 10 in particular, and we said in general, we've got to consider our risks, including risk-free risk and an increment for market risk and project-specific risk and duration risk. We have to consider these in our risk models somehow in either our cash flows or our discount rates, which usually, and for the rest of the term, we'll be using some sort of opportunity cost of capital discount rate. And we've been using point estimates for both of these, for our future cash flows and our discount rates. Some of the problems with this are that our opportunity cost of capitals and our future cash flows are both random variables. And as I just pointed out, we've been using their expected values without thinking about their distributions, about their probability distributions. So, for example, if we had a situation where we were looking at stupid manager or project-specific risk, we would say something like we felt there was a 90% probability that a promised cash flow in 2 years was going to be 100, but in our view, there was a 10% probability that the management would screw up, and we would get, in this case, nothing. So when in a case like this, we would estimate as a single point estimate our cash flow 2 as 90% times 100 plus 10% times 0, and that's equal to, of course, 90. And that allowed us to say something like, over the long haul, if we do a lot of projects just like this one, we expect on average that cash flow 2 would be $90. And what we haven't addressed in this model is something like what happens in this case, in this particular case, if the project manager screws up, and what is the probability of this screw up for this particular case. We've just gone ahead and used the $90. So now we're going to use probability and statistics to do better with our risk models. And what we'll be doing is we'll be looking at the probability distributions that are behind the expected values that we've computed previously. So for the above example, if we consider the entire distribution that got us to that $90, we'd say that cash flow 2 is estimated to follow a Bernoulli distribution. Bernoulli distribution is just a yes-no distribution, and it's distributed as probability of 90% that we get 100, probability of 10% that we get 0, and that gives us our expected value of 90. So we're going to be looking at everything, not just the expected value, but all of the cases that go into making that up. And this allows us to say more to our clients or our bosses if we're working for a CFO or a CEO. So we can say better things and more things. Like, for example, our best guess is that on average, our cash flow 2 for these types of projects is 90. That's what we've said before, but we can add to that. This is based on our view that 90% of these projects will pay the promised cash flow of 100, but 1 in 10 will flame out, resulting in a cash flow 2 of 0. So we're saying more here, so we're able to do a bit better. And this now explicitly captures for us the fact that those risky future cash flows may not happen in full or at all. So this way that we did this was twofold. We included our point statistic for reward, and that's our expected value of cash flow 2. And now we've added to that our spread of the probability distribution that got us the expected value for risk. So that's what gave us our worst outcome of 0 with 10% probability, best outcome of 100 with 90% probability. So we're just adding this understanding and analysis of probability distributions to our risk models. So let's look at an example here taken from the time frame, March 2020 timeframe, during the middle of this coronavirus outbreak in the United States. So if we were considering buying several bonds, let's see if we can do a full high quality probabilistic analysis of these bonds. So let's say we're looking at a treasury bond and a bond of General Electric and a bond of United Airlines. Okay, so the promised cash flow for the treasury bond is 100, and the worst case, and this is our estimate. Okay, so we've done some work on this that would be given to you in this class. There's a lot of analysis behind this. So we, or our general manager, our CFO, does a lot of work on this and estimates in the worst case, the Treasury is going to default. Why is it going to default? Well, it just allocated $2 trillion for the US economy for various functions, and they're going to have to sell bonds to make that happen, and maybe they're going to have a problem selling their bonds, that sort of thing. And we do say, however, the United States Treasury is still considered the safest thing in the world. So even in an extraordinary crisis like this, there's about a 1% probability that the Treasury is going to run into trouble with this bond. So what I'd like to do here is to fill in the missing information. So the expected value for this guy is exactly what we've been doing before in chapter 10 and on the previous pages of this lecture. So for our expected value, we're going to have 99% times 100 plus 1% times 80. Okay, and we'll work that out. And what do we get here? We get 99.8. Okay. So that's good. And now for GE is in a slightly different position. GE is a case of a very high quality, fairly well functioning company before the crisis hit. They have been restructuring themselves, but they certainly haven't been in danger of going bankrupt. So they have a bond. These are one-year bonds. So we're looking at cash flow 1, and we're assuming in this case we have these are annual pay bonds with just cash flow 1 coming up. And we have here the promised cash flow from this bond is again 100. And then again, our boss or our general manager, our CFO, has done a lot of work and estimated that GE might run into trouble with this bond. It might have to declare bankruptcy. And if it does, we estimate we will get something, right? Because bondholders typically get something in bankruptcy. And the CFO or our boss's best estimate is that would be $65. And we have some probability of worst case that we want to solve for. And we know that if we get the right answer, the expected value cash flow is 98.25. So let's see if we can set this one up. This is going to be exactly the same thing. So I'm going to start with x times, we need to solve for x, which is this over here. Okay, so I've got x times the probability of the worst case is associated with the 65, plus I have over here the 1 minus x times 100 is equal to 98.25. Okay, so I think if we do the algebra on this guy, we're going to find that x equal 5% works. Of course, I've already done the algebra, so let me just show you that that is really true here. So I'll bring this down here, and I'll put in 5% here, and I'll put in 1 minus 5% here, and I'll turn this into an equation to be solved, and we have a little formatting issue there. And once we get that solved, we do see that 5% probability of worst case does give us our 98.25. So I'll just come back over here and say x equals 5% for that one. Okay, and then let's go ahead and see if we can do the same thing here with United Airlines. Now, United Airlines definitely is a company that is in grave danger of going bankrupt because of the coronavirus problem. They're estimating that they're going to have 6% capacity on their planes. Right now, they're running at about, as I create this lecture, they're running at about 25%. So clearly, given their fixed costs for paying their pilots for fuel, for maintenance on their planes, things like that, they're going to be wildly cash flow negative from their operations and go bankrupt very quickly if they don't get help from the government. So once again, our boss has thought about a lot of things. She has a view on what kind of bailout, if any, they're going to get, et cetera, et cetera. So she comes up with worst case if they do go bankrupt, that because they do have planes and things like that that can be auctioned off and sold to the sold for the bondholders to get the proceeds, that there will be something there. And she believes that there's a 75% probability that United Airlines and other good airlines are going to go bankrupt, and her expected value here is 70. So let's see if we can back into the promised cash flow in this case for United. Okay, so in this case, we're going to have her best case is only 25%. So we'll put that in equals 25% times x, and then plus 75% times 60 is equal to 70. All right, so in this case, we just solve for x. So we can say x is equal to 70 minus 75% times 60. And that whole thing needs to be divided by 25%. So let's go ahead and do that. Okay. And that looks good to me. And we'll go ahead and solve that. Okay, and indeed we get 100. So in this case, x equals 100. So this was $100 promised for cash flow one, same as the other two. Okay, and so what have we done here? The nice thing about this table is that it tells us everything that we need to know about the project-specific risk for these bonds. We've explicitly considered the best and worst case cash flows, their probabilities, and the expected values. If we kept repeating this by the Treasury experiment in a situation like the height of the 2020 coronavirus outbreak, we'd get on average over the long haul 99.8 and et cetera, et cetera. Okay, good. So our framework for modeling financial risk and reward that we're going to use going forward when possible, especially for our cash flows, is like this. We're going to admit that our cash flows and our discount rates are random variables. We're going to estimate a probability distribution for these quantities, and we've pretty much just covered how we're going to cover cash flows for zero coupon bonds. And we'll use the expected value to estimate our future reward, and we'll use some measure of our distribution spread, standard deviation, or something like that to estimate future risks. So to do that and to generalize what we've done here beyond something like 1-year bonds where we're considering the cash flows as Bernoulli distributed, we need to go a little bit farther into thinking about statistics and probability. So let's consider cash flows versus returns and start with a 1-year 2 cash flow project where we have cash flow 0 and cash flow 1. Cash flow 0 is, as always, now, okay, and this is going to be in 1 year. So cash flow 1 is clearly a random variable. And it's measuring the uncertainty of cash flow 1. We want to measure that uncertainty of cash flow 1 via a probability distribution. We also want to start thinking about returns for this project. And we define our return for a project like this as the cash flow that we get back at the end of the project, that's cash flow 1, minus the cash flow we put into the project at the beginning, that's cash flow 0, divided by the amount we put in the beginning. So since cash flow 1 is a random variable with a probability distribution, the return is also going to be a random variable with a probability distribution. So let's consider another 1-year project. Let's consider we buy a stock today, we hold for 1 year, and we sell at the end of 1 year. Or if we think we're going to continue to hold the stock beyond that, we will pretend that we're selling at the end of the year. Okay, so in this case, it's pretty easy to compute the return for this project. That's going to be the price of the stock at the end of the year, okay? So this is at EOY 1, and this is minus the price at t equals 0, which is EOY 0, and divided by the price at end of year 0 when we start the project, okay? And so going forward for the rest of this chapter, we're going to model our risk and reward with either cash flows or returns. Okay, so now let's take a deeper dive into stock returns and how we want to model the risks and rewards of stock returns. So let's start with a very straightforward project. We're going to buy 1 share of the SPY ETF, hold it for 1 year and sell. And as we know, the SPY is an ETF that aims to replicate the returns of the S&P 500 stock index. And just to give you a little context, at 3/26, 2020, SPY is off by 30% from February 2020 peak, and in the Great Recession, the SPY and the S&P 500, of course, it lost about 50%. So it's quite possible this coronavirus problem that we're having in 2020 is worse than the Great Recession. And if that's true, the S&P 500 and the SPY will continue to decline at some point. Okay, so enough of the real-world context. In general, how are we going to characterize the returns for this project in terms of reward and risk? So remember, for a project of this type, Our return is just price at end of year minus price now divided by price now. So how could we figure this out? Well, here's a very common way to do this. We're going to characterize the returns of the SPY via these steps. And what I mean by characterize is characterize probabilistically. Okay. That's our whole goal here is we want to do something similar to, something analogous to what we did with the cash flows of the bonds that we looked at before that were Bernoulli distributed. These are going to turn out to be normally distributed. So to start with our characterization of SPY returns, step number one is we want to look what's happened historically. So we're going to build a long list of historical annual returns. So I've got a partial list shown going back to 1992, but we would want to go back way beyond that, at least to 1980, maybe farther than that. So I have my closing price here of the SPY for each of these years, okay? And then from those closing prices, I can get the return using the equation we just saw on the prior page. So for example, the 2018 year return, which we have here at minus 2.43%, how did I compute that? Well, how did I have Excel compute that? More to the point, I said 267.4455. That's the price at the end of the year, minus 274.0989. That's the price at the beginning of the year, divided by 274.0989. And that's how, using these two numbers, I was able to get that return. And that same computation is true for every return computed here. Okay, so that's step number one. Step number two is, now that we have all these returns, let's do a probabilistic statistical analysis on this data. Okay, and so always good thing to do when you're analyzing a random variable and you have some historical data is to create a frequency distribution. So here's our frequency distribution graph here. Okay, so okay, and this pretty much should look kind of like a normally distributed set of data here, okay? And that's what typically is always assumed in a case like this for stock data. And why is it always assumed to be that way? Because the distribution graphs really do honestly typically look like this, okay? So this is our histograms, our frequency distributions typically do look normal for annual stock returns over time. So once we say that, we can go ahead and numerically compute our key statistics for the historical data. Okay, so I've gone ahead and done that for us, and I found our average return. X bar is, of course, for our sample data. Our average return was about 8%, and our standard deviation sample, once again, was about 25%. Okay, so that's step two. So we have a pretty good feel now statistically and probabilistically for what happened in the past. We can say the annual returns historically of the S&P 500 tend to look normally distributed, and they had an average annual return of 8%, a standard deviation of returns of about 25%. So our third step is to say, how can we carry this into the future? We're concerned with making an investment like this today and what's going to happen when we come out on the other side a year from now. So very, very important, okay, is to decide what we're going to do in the future. We have to start with a key foundational assumption, and that is that the future returns for the SPY and the S&P 500 are going to look like their historical returns. Okay. Okay, we can't really do much without making that assumption. And this may be a bogus assumption, and I'll talk about that more in a little bit. And once we make that assumption, okay, so once we make that assumption, then we can say, okay, well, if the historical returns look normally distributed, we can say the future returns will be normally distributed, and we can estimate them with our normal density function. Okay, so what we're going to do is we're going to morph this frequency distribution into, say, hey, let's model this as completely normally distributed using the normal density function, and let's morph our sample expected value into the expected value of the normal density function, so we'll call it mu, and the standard deviation from our sample S, let's morph that into the standard deviation of the normal density function, call that sigma. So the numbers are the same, and we've changed the symbols to make it clear that we're now working with the normal density function. So there are two implications of our model here, and one is that we're going to consider our reward measured by our expected value mu. So what do I mean by that? We say something like our best guess at next year's return is 8%, and we can also say on average over the long haul we expect SPY to return 8% annually. So that's how we think about our reward. And the second thing is we want to think about our risk. So our risk is going to be measured by probabilities based on the spread of our normal distribution of returns. And as we know, more spread is going to give us more risk. And I've tried to illustrate that for us here over on this graph where I have three different types of investments. Okay, so these are probability distributions. Hang on just a second. Let me move that over, make this pretty. Okay, and down here on the x-axis, I have my return percent. So if we look at something like investment B, so this could be SPY, whoops. The SPY annual returns, we have something that is very, very spread out here. So there is something like maybe a 5% probability that we're going to have a minus 30% return or worse. Okay, and there is something like a 50% probability that we're going to have a 20% return or better, things like that. Okay, and if we look at the other hand on investment A, which might be something like corporate bonds. Okay. We find that we have much less spread of returns. We could still get negative returns. Companies could go bankrupt, right? And we're not going to get everything back, but because we have those great contracts, we will get something. But we have much less spread, so that's much less risk here. And if we look at our third investment here, US Treasury notes, we see there's almost no spread, okay? And the reason for that is that, as we know, everybody in the world considers the Treasury the safest investment out there, so the probability of doing better, doing worse is very, 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 very low. Okay, the other thing that's important to notice about this is as we take on more risk here, as denoted by the wider spread, we have a higher reward, a higher expected value. Okay, so the expected value of the SPY is higher than the expected value of the bonds. and that's higher than the expected value of the treasuries. So this is our classic risk-reward trade-off. The more risk we take, the more spread we have in our returns, the higher the probability that we could have a very bad outcome here, the higher the reward on average measured by expected value. And if we're very risk averse, if we don't like risk at all, then we would want to be in something like treasuries, but we're going to pay for that with the lowest expected value of just about anything we could do. Okay, so we're going to be measuring our risk one way or another by looking at the spread of our normal distribution of returns. And we'll use a graph something like this to help us do that, okay? We're going to want to compute probabilities of our normally distributed returns, and let's see how this is going to work for our SPY example, okay? So we have, with our SPY example, we have expected value of 8%, standard deviation of 25%, and this is the normal density function graph here. And what I've got on the x-axis is measured in standard deviations away from our expected value mu, and the percents here are probabilities. So 19.1%, for example, means we have a 19.1% probability of our return being between mu, which is right here in the middle, and mu plus what? 0.5 times sigma, okay? And separately, there's also a 19.1% probability of our return being between mu and mu minus 1/2 sigma, okay? So we have two of these 19.1%. One is 19.1% probability will be between 8% and half of 25% plus 8%, and same thing, corollary on the downside. All right, so let's see if we can actually compute some probabilities and associated ranges using the graph back over here. Okay, so let's compute the probability that the annual SPY return will be within, okay, mu minus 1 standard deviation to mu plus 1 standard deviation. Okay, I'm actually going to start with the range for us, and that's going to help me look back at the graph and get the probabilities here. So what we've got here is 8%. Our range is going to be 8% minus 25% to 8% plus 25%. Okay, and that gives us, if you do the arithmetic on that, that gives us minus 17% to our 8 plus 25, I think is 33% in most circles. Okay, so that's the range that we're going to be in. And now let's go back to the graph and get the probability. Okay, so here's my mu, okay, which for us is our mu equals 8%, right in the middle there, and also sigma equals 25% here. We can put that over here just so we remember it. Okay, so I just want to add up my probabilities from minus 1 standard deviation down from mu to 1 standard deviation above mu. So I add 15 and 15, that's 30, and I add to that 2 times 19.1, and you can check this out along with me, that is going to be 68.2, 2 times 15% plus 19.1%, and that's equal to 68.2%, okay? So what does this tell us? Now we can say that there's about a 2/3 probability in any given year that the return of the S&P 500 is going to be between about minus 17% and 33%. So that's a really helpful thing to know. So let's see if we can do another one. What's our probability that our return is going to be one standard deviation below the mean or less? Okay, so let's start this time with the probability. Okay, so I have one standard deviation below or less. So all I have to do here is add up all of these probabilities until I get to one standard deviation below the mean. So that'll be 0.1 plus 0.5 plus 1.7. So that's going to be equal to 0.1% plus 0.5% plus 1.7% plus, now I need to look back, 0.1, 0.5, 1.7, 4.4, and 9.2. Okay, so 4.4 plus 9.2%, and if you work that out, you should get 11.5%. Okay, so what's our associated range of SPY returns? Well, we already got the edge here for sigma minus 1 standard deviation. That turned out to be minus 17%. So the range is going to go, in theory, from minus infinity to 1 standard deviation below the mean, and that's going to be minus infin to minus 17%. Okay. So that's our range, and graphically that covers this whole downside tail. So how do we want to describe this in words? This is extremely helpful and important. We want to say something like this. We want to say that there is an 11.5% probability that our annual SPY return will be minus 17% or less. And let's finish our quote here. There we go. So this is a very helpful thing in terms of risk. And we're going to start looking at these left tail kind of statements more and more. Okay. And this is a good time to bring up some problems with this model. Okay, one, some of you I'm sure have already noticed, okay, Okay, so one is the returns can only go to minus 100%. Normal goes out to minus infinity. Okay, so that's not great, but the amount of the tail below 100% out here is very, very small, so we just deal with that modeling error. Okay, and the second thing is that, remember our foundational assumption? We assumed future returns will look like past returns. Okay, and that's not necessarily so. Okay, that's maybe a reasonable assumption for something like all the stocks in the S&P 500, but if we're looking at an individual company in particular, that's definitely not true. If we look at Apple, for example, it was growing by 200% a year 12, 15 years ago. Now it's growing by maybe 50% a year, has a completely different product line, completely different set of risks. So the more specific we get here by looking at individual companies in particular, the worse this assumption, future will look like the past, becomes. Okay, so a real good example showing how future returns may not look like the past comes from this article that I've put in readings for us. And this guy who's writing this article is explaining his form of investing that doesn't so much assume a future will look like the past kind of model. It's an interesting article overall, but what I want to bring your attention to in particular is the average lifespan of an S&P 500 company. And you can see back in the good old days, the average lifespan of an S&P 500 company was 55 years, and it's down now to less than 20 years. So what that means, it may still be not mean too much for the S&P 500 because the 500 companies rolling in and out don't affect the index too much overall. But if we're looking at one company, the fact that its lifespan now is less than 20 years means that using a historical future looks like the past model is clearly not going to work, because we want to have, as we know from basic statistics, we want to look back, we want to have a data set of returns of at least about 30 years, right? So if the companies are only lasting 20 years, clearly our future looks like the past model is not going to work well because our data set isn't big enough to make it work well. Okay, enough on that. So we can also find more information on probabilities for our returns of something like the S&P 500 by using any old online normal density function calculator, or we could also use Excel's norm inverse function. So for example, we could find for the S&P 500 that we have about a 5% probability, which would be once in every 20 years, that the S&P 500 or the SPY returns will be minus 34% or worse. Okay, that's pretty scary, right? That's losing an awful lot if you've got your whole retirement baked into that, or your child's college education baked into that. That could be really bad news. So let's see how I got to that using the norm inverse function in Excel. So I'm going to say norm inv, and once I need to make it the real deal here. Hold on just a second. There we go. That's what I'm looking for. The little helper down here. So the norm inverse function gives me, if I put in the probability I'm interested in, so that's 5%, and our mean return for the SPY is 8%, and the standard deviation is 0.25. Okay, and there is our, in this case, 33% return. So not quite 34, 33% return. So the norm inverse function gives us what's our return going to be if we're thinking that we want a 1 in 20 year probability of that return or worse. So this is actually important. This criteria, what we just did, where we're asking, what is the downside range of returns that we expect 5% of the time? When we ask this question, this is called the value at risk criteria. This is a very important criteria. Clearly, I can't ask you to compute it on exams because we do need something like this to compute it, but I do need you to understand the concepts. It is important because it's used by banks, the Fed, smart fund managers. It's used all over the place. Jamie Dimon at JP Morgan Chase gets a 20-page value at risk report on his desk every day, looking at the value at risk of various investments and strategies used by JP Morgan Chase. And I do have another article I've put up in readings for us from the CFI group, not to be confused with the CFA Institute, on more about how VAR works and what it is. So if you're more interested in that, you can look at that article. Okay, so we can also, using, let's say, a normal density function calculator to answer questions like this. This is a really good question that inquiring minds want to know is, what's the probability that our return will be less than 0? So we could use an Excel function for this, but I just want to also show you that we could pick out any old online density function calculator to get this too. So you can see what I'm using here. I've got the URL up here. It's pretty simple. And I'm going to put in our mean of 0.8 8%, and I'm going to put in our standard deviation of 25%, and I want below 0. Okay, and what I find for that is that we have about a 37% probability in any given year that we're going to have a negative return. So if you're a little bit shaky on using the normal distribution to do the types of things we're doing here, I strongly recommend playing around with one of these online calculators. They're very good at illustrating what's going on here. So here's 0, and here's our probability, the area under the curve from 0 out to minus infinity, which, as you can see, to get to minus 100% here, we're going to be way out in the tail. So it's actually not so bad to use a normal distribution to model these returns. So in any event, return of 0 or less, area under the curve is 37% of the whole curve. That means 37% probability we get a return of 0 or less. Could be minus 67%. Okay, so let's keep moving. So a couple more things to get to in this chapter. The next is upside versus downside risk. In general, investors should, of course, be more concerned with downside return risks, which are losses, okay, than upside return risks. And what we want to do to ensure that we're focused on downside return risks is try to, whenever we can, measure our risk with downside left tail probabilities. And that's going to be instead of standard deviation. We can use standard deviation to measure risk, but it's better to do this type of thing. Use something like value at risk. What's the probability our return will be less than 0? Because when we're doing that, as you can see on the graph here, we're focused on the downside tail, the loss involving tail here, and that's great. That's great for a couple of reasons, because it's going to help us with any type of probability distribution for our investments. So if we have normally distributed returns like we do with the spiders and the SPY and the S&P 500, the upside and downside are symmetric. So it's not necessarily so bad in that case to use standard deviation. But here's a realistic probability distribution for a very simple portfolio. This is a portfolio that has a bunch of shares of the SPY ETF, and it's got some SPY puts in it. And so the puts have the effect of making this tail not be so attenuated out here, the loss tail. So if we were trying to measure risk with something like standard deviation, which is symmetric, it's just not going to work on something like this. And again, this is a very simple portfolio used by many mutual fund and hedge fund managers. So again, the downside risk measures that we want to consider whenever we can are things like this. The probability that our return will be less than 0, that's exactly what we saw over here, or less than some other meaningful threshold. Doesn't have to be 0, right? For companies, when they're looking at a project, they often say things like this: if we lose more than 30% on this project, we're going to go bankrupt. So they want to know what's the probability that they're going to lose 30% or more. So another one, which we just looked at, is our value at risk criteria. And that's our value X, where there's a 5% probability that our return will be less than or equal to X. And in general, any of the or less or worse measures that we looked at above. And as long as we're focused on this left side tail for risk, it's going to work with any type of probability distribution that's characterizing our returns. Okay, and the last thing that we need to talk about in this chapter is what's called volatility drag. And volatility drag is associated with multi-period risk. So far in this chapter, we've considered projects with just one investment period, 1 year, 1 month, etc. And of course, as we know, most investment projects exist over multiple compounding period. So for example, an investment project might be we're going to put a certain amount of money into the stock market now to, in 15 years, over a 15-year period, build enough cash to pay for our child's college education. So that would be a multiple period project, okay? So when we have multiple period projects, how do we want to evaluate them? We want to consider their performance by the growth of our investment over the life of the project, not by just the average and spread of our single period returns. So let's look at an example showing how this works. So if, for example, we're investing 1,000 in to cover our child's college expenses at the end of 5 years, and we have just two choices: exchange traded fund A, ETF A, or exchange traded fund B, ETF B, and we want to know which is best. So what I've got here is the returns for A, the returns for B, and the end of year annual return going out for 5 years. Okay, so if we just look at the average returns and standard deviations, we'd see that B has a higher average return than A. So if we didn't know any better, we might say, well, clearly we want to go with B because it has the higher average return. But it's also good to look at, and important to look at, the volatility of the returns measured by something like the standard deviation of returns. In this context, standard deviation is a nice thing to use. So A has a standard deviation of 0 because it's looking something like a treasury, right? It's returning 3% a year no matter what, no ifs, ands, or buts about it. Okay, so ETFA might be something that invests only in treasuries. And B, you can see it's very, very volatile, minus 15%, 1%, minus 10%, 15%, 25%. So if we take the standard deviation of that, we get 15%. So the way we want to measure performance in a case like this is to answer the question, something like this: what's our pile of money at the end of 5 years in each case? So we can do that for A and we can do that for B. So the way that these two columns are working is we're starting out with $100,000, the units here are K, in each account, okay? And then at the end of 1 year, this grows to 1.03K dollars, and this one, because the return here was 15%, goes down, declines to $0.85 thousand dollars, and we keep doing that every year. Okay, so this is measuring the total pile of money in the account. And this is a really good thing to measure. So we've got A steadily growing, steadily growing, steadily growing, steadily growing, and we wind up with 1.16K dollars for A. And for B, notice how even though it's got a higher average return, the pile of money that we have at the end of the day is less. So the reason for that is because of what we call volatility drag. The higher the standard deviation, the more that the returns, the total return over the multi-period set of years for the investment, is going to be degraded. So the higher the volatility, as measured by standard deviation, or we could do it by probability of loss, it doesn't matter, the more the pile of money we wind up with at the end of the day is going to be reduced. Okay, so with that in our pocket, let's just make sure that we can all compute some of these numbers. So I'll just do a couple examples here. So how did I get this 1.03 1.03, the way it works in all cases is what we have at the end of the year is equal to what we had at the beginning of the year plus the return times the BOP balance. Okay, so what we had in the beginning of the year here was 1.0, and I'll just do a little bit of algebra on that, and I'll say 1 plus 3%. Okay, and that's how I got to my 1.03. And the same thing with our 0.77. How did we get to that? Well, in that case, our beginning of period balance was 0.86 times 1 minus, and what was our return there? 10%. You see, here's the return for that year, my 10% over here. Okay, and a good thing to measure with projects like this, you can compare the pile of money that we have at the end of the project with different investments. We can also compute something called the total project return, which is also very helpful, very useful. And the total project return is just simply what we wound up with minus what we put into the project, quantity divided by what we put into the project. So for our 11.1% return here, how did I get that? Fairly straightforward, just like in the same way we computed our annual returns for the SPY index here. I have 1.11 minus 1.00 divided by 1.00. And that clearly, that's 11.1%. Okay, so that's how volatility drag works. So if you have a long-term multi-period investment, don't be fooled by just the average annual return. You also have to think about how volatile are those returns. And if they're volatile, you're gonna have a degraded total project return because of that volatility drag. So you can also see graphically how this works. If we look on the next page, I've got a graph here of, on the x-axis, how many years have elapsed since we started investing, and on the y-axis, the pile of money that we have at any time during that investment. So you can see here that for A, even though its average annual return is less, because it's so consistent, we wind up with a bigger pile of money because we had a down year our first year for B, and then a pretty much flat year, another down year. And even though we had two very strong up years at the end, it couldn't pull our total amount of money back up to be equal to A. And so the other thing that's interesting about this is that this is path dependent. If we ran this test again and the order of the years happened to be reversed here, if we started with two very strong years for B, then it would have turned out that B did better than A. But of course, because we can't predict the future, we don't know when our volatile returns are going to be high on the upside or high on the downside. We certainly can't count on that. So figuring that out carefully is done with what's called Monte Carlo simulation, which is beyond our scope. So I think we'll just leave it there. Drag. Okay, and that's it for this chapter, and I'll look forward to seeing you soon.